101 series. Today, we're discussing the Statement of Changes in Equity, which tracks changes in the owner's equity over a specific period. This report is key to understanding how profits, losses, and investments impact the value of your business. By the way, I'm Nanette Picayo, CPA, a virtual bookkeeper and accountant.
So let's go to purpose of the statement of changes in equity. So the purpose of the statement of changes in equity provides insight into how owner's equity has changed due to profits, losses, dividends, and additional investments. So this refers to the changes after the year. So after the profits, losses, so let's to show you more. So key components, beginning equity. The equity balance is the start of the period. So this is the ending balance at the end of the previous period. So we will carry over the ending of the previous period, and it will be used as the figure at the ending of the previous period will be the beginning equity, beginning balance of this year's period. Okay, and then we will add after the beginning equity, so we will add the net income. If we incur loss, so we will deduct the loss on the beginning equity. So profits or losses that increase or decrease equity. So net income will increase equity, loss will decrease equity. And then dividends. So distributions to shareholders that reduce equity. So dividends, they will be deducted to the beginning equity since it is distributions. This refers to distributions of dividends to shareholders. So additional capital contributions, since contributions from the word contribution, so new investments by the owners that increase equity. So they will increase equity. We will add the contributions, the new investments. So the formula will be beginning equity, add net income, or deduct net loss, and then deduct dividends, and then add contributions, the new investments. So this is the example of changes in equity. Changes in equity. So at January 1, so the figures here are the balances on December 31, 2017. We will have to carry over the balances there and will be considered the beginning balance on the next period. So here from our example, nothing changes in the accounting policy, nothing has been changed. Prior period correction. So new paid in capital, so this the 10,000. So since new paid in capital, it will be added. Net profit, add. Revaluation gain, add also, and then owner's withdrawal, deduct. Okay, so this is the changes in equity. Why there's a column here? Because if you will compute the share capital, so this is the beginning, this is the new paid in capital, and then if someone will ask how much is the share capital for the period, so this one 65,000, retained earnings 38,000. So the changes in retained earnings are the of course the beginning, and then the net profit, and then the owner's withdrawal. Revaluation, so yeah, this the balance of revaluation is this one. And then the total statement of changes in equity, so this one. So on the next year, after this 2018, these balances will be the beginning balances on January 1, 2019. So since we will carry over the balances on the next year, the ending balances on the next year. So
today we explored the statement of changes in equity, a report that helps you understand how your equity has evolved over time. In the final video of our series, we'll recap the key accounting concepts we've covered and provide practical tips for small business owners, students, aspiring bookkeepers, and accountants. If you found this video helpful, please give it a thumbs up and don't forget to subscribe to our channel so you won't miss the next video in our series. Feel free to comment below if you have any questions about the topic or other topics you'd like us to cover. Thank you for watching!